In today's video, you will dive into all of LuxAlgo's price action concepts. You'll learn about every feature in this toolkit, discover how to utilize them, and understand simple methods for mastering these tools. By the end of this video, you're guaranteed to have a complete understanding of what's happening on your chart. This is especially crucial for newer traders who might feel overwhelmed at first glance. So let's jump right in. Let's open up the settings and start with market structure. Looking at internal and swing, you'll notice labels like chalk plus, chalk, and break of structure. Let's clarify what these mean. Firstly, let's talk about what internal means in market analysis. Internal are smaller structures in the market, so they look at less candles, they look at a small range of candles, and they're looking for small things, small price action that occurs in this small area. So these dotted lines, for example, are break of structures that are internal. So BOS stands for break of structure. What it's basically saying is, you can see a structure here, and there's some kind of support line here, and the price is breaking through this support line. So it's a break of the structure in the market. When you see a red break of structure, it might indicate the market could be moving down. It's continuing its trend. Breaks of structure often occur in trend continuations. So, if we're in a downtrend and there's a break in structure, it's marked as BOS. This signifies a continuation of the trend, confirming a downward movement. Similarly for green, you'll see a break of structure signifying a bullish movement. When you observe a break of structure that's bullish, it means the market is breaking above, pushing through. These signals can serve as entry points or buy signals, or simply as confirmation of a trend. Essentially, they indicate trend continuations, signaling an upward movement. Next, let's discuss CHACH, another key element you'll encounter on your chart. CHACH stands for change of character, indicating a shift in the market's direction, whether from bullish to bearish or vice versa. When you come across a CHACH, it's signaling that the market's trend is altering. For instance, if you see a CHACH plus, though we'll focus on the CHACH part for now, it means the market was previously in an uptrend and is now shifting its character to enter a downtrend. Essentially, it serves as a type of reversal signal, highlighting a significant change in market behavior. And here's another CHACH. This one isn't a CHACH plus, but we'll dive into what the pluses signify shortly. When you see a green CHACH, it suggests a potential shift from a downtrend to an uptrend. It's as if the market is signaling, after a period of downward movement, now might be the time for an upward trend. So, when you're observing a sequence of downtrends followed by a CHACH, it's indicating that the market was previously trending down, but is now poised to change its character to an uptrend. These signals are given in real time, allowing you to make trade decisions as they happen. The key difference between a CHACH plus and a regular CHACH lies in the early signals preceding the CHACH plus, indicating a potential market reversal, such as a failed higher high. This means a CHACH plus offers a bit more confidence in predicting a shift in market structure. However, if you're new to trading and still becoming familiar with these terms, you can treat both labels similarly in your analysis and decision making. Following that, we observe a CHACH highlighted with a solid line, indicating a swing market structure. The solid lines are swing market structures, using a higher look-back period to be detected. If you open your settings, the internal market structure uses a look-back period of 5 to detect a market structure, but the swing market structure uses a look-back period of 50 candles to detect a market structure. Next up, we encounter terms EQH and EQL, where EQH stands for equal high. This concept is used to describe a situation in the market where, after reaching a high point, the market rises again to the same high level. These equal highs are at comparable levels, signifying a potential reversal. It's generally considered a reversal signal. Therefore, when you spot an equal high, it might suggest that the market is poised for a downturn. Similarly, EQL stands for equal low, which could indicate a scenario where the market has formed what's often referred to as a double bottom. This occurs when the market drops to a low point, rises, and then drops again to the same low before ultimately reversing direction. Both equal highs and equal lows serve as important reversal signals, suggesting potential shifts in market direction. Having covered the market structures, it's important to note that you have the flexibility to turn them off easily through the settings. If the market structures aren't to your liking, or if you find them cluttering your chart, you can remove them with just a few clicks. Similarly, the indicators for equal highs and lows can also be toggled off. This customization allows you to tailor your chart to your preferences, ensuring a cleaner view or focusing only on the elements that you find most useful for your analysis. Now let's explore the color candles, which are directly influenced by those market structures we discussed. You can easily enable this feature again, and when you do, the color of the candles provides immediate insight into market sentiment. Green candles indicate that market structures are turning bullish, while red candles signal a shift towards bearish trends. This color coding follows the trend direction, red for bearish trends and green for bullish trends, making it very straightforward to interpret. For those who appreciate the visual simplicity and immediate feedback of candle coloring, this feature is particularly appealing. Now, let's focus on the order blocks observed during the current price movements. These blocks might appear daunting at first glance on your chart, but they're quite straightforward. What you're looking at are essentially supports and resistances, pivotal levels where the price tends to rebound. You'll notice how the price interacts with these levels. These order blocks serve as support and resistance on your chart, making them invaluable for setting take profits, stop losses, or other trading strategies you might employ. Next, let's dive into the metrics inside the bar, which represent the percentage of volume that occurred within an order block at the time it was generated. These 5 order blocks together account for 100% of the market volume. However, take special notice of particular order blocks with a significant higher volume share. It signifies that a majority of the market's volume was concentrated here, marking it as an exceptionally strong order block. Such a high percentage suggests it's more likely to serve as a solid level. Contrastingly, an order block with a low percentage may not be as robust. Next, pay attention to the figures beside the percentages, which represent the actual quantity of the volume. This helps you gauge the level of market interest and the significance of the volume at different levels. Next, focus on the volume, represented by these green and red bars, which are crucial for understanding the construction of order blocks. Take a closer look at an order block. You want to notice the volume data present when this block was formed. For example, this one is predominantly bullish, as indicated by a significant green bar. This suggests that the order block is primarily bullish, revealing a preference among buyers to trade at this level. And here, bears show strong dominance at this level, which is quite intriguing. For example, this one is predominantly bearish, as indicated by a significant red bar. This suggests that the order block is primarily bearish, revealing a preference among sellers to trade at this level. If you're looking for a simpler chart, it's completely in your control. You have the option to disable the buy-sell activity and metrics for a clean view. This way, you'll see just the basic support and resistance zones. It's straightforward to make these adjustments using this toolkit. You might come across an option called mitigation method. Essentially, mitigation means that the market has addressed the order block. This happens when the price reaches and either passes through or completely ignores the order block, or when it has fulfilled all pending orders. At this point, the order block loses its significance. The key question for you is determining the moment an order block becomes irrelevant to your trading strategy. You have 3 options to manage order blocks. First is the close option, which eliminates the order block as soon as the price closes above its highest point. Second, the wick option, where the order block is considered mitigated if the candle's wick touches it. Lastly, there's the average option. This removes the order block when the price crosses a specific average level, indicated by a dashed line. Shifting focus to liquidity concepts, let's discuss trend lines, a familiar tool for most traders. Trend lines are valuable for identifying areas rich in liquidity, often serving as crucial support and resistance levels. You'll notice how the price tends to rebound from these lines repeatedly, wondering how to leverage trend lines in your trading strategy. When the price decisively falls below a trend line, it presents a prime opportunity to consider a short position. Conversely, a price surge above a trend line signals a potential for a profitable long position, albeit more suited for quick trades or scalps. Essentially, trend lines guide us in understanding market movements, offering straightforward cues for entering short or long trades based on their breach. For those who appreciate the intricacies of trading patterns, this toolkit includes a feature specifically for pattern detection. By simply activating the Patterns option, a dashboard will appear, highlighting detected patterns on your chart. Moreover, the feature allows you to adjust the scope of its search, determined by the number of candles it reviews. For most users, setting this number to 5 serves as an ideal starting point, ensuring a balance between relevance and comprehensiveness. Diving into the final liquidity concept, let's explore liquidity grabs. Upon activation in the toolkit, you'll notice a distinctive blue box appearing at the bottom of certain wicks. This feature aims to highlight areas of intensified trading activity, often in more liquid segments of the market, suggesting potential zones for reversals. In essence, these blue boxes can serve as cues for long positions. When you spot a candle with a blue liquidity grab beneath it, consider this a strong hint of a market bottom, signaling a possible reversal. These indicators are particularly useful for quick trades or scalps. A red liquidity grab, conversely, indicates an opportunity to short as it predicts further downward movement. These tools are designed to be unobtrusive, clearly marking areas of liquidity without cluttering your chart. Real-time and highly favored among traders, these liquidity grabs provide clean, straightforward signals for entering trades based on market liquidity dynamics. Next up, let's dive into the concept of market imbalances, focusing first on what's known as fair value gaps. Imagine the market as a balanced scale, typically following set rules. When it starts to tip, showing signs of imbalance, that's where fair value gaps come into play. Simply put, a fair value gap occurs when the market shows a specific pattern over 3 candles. The wicks of the candles on either side don't touch the body of the central candle. This pattern indicates a disruption in what's considered fair value, suggesting a trading opportunity for you. When we identify a fair value gap, it highlights a significant movement in price action. The key insight with fair value gaps is the expectation that price will eventually return to this area, aiming to correct itself. In real time, when spotting a fair value gap, it signals that the price needs to revisit this specific zone to fill the void left behind, achieving balance once again. You'll witness this process as the price dips and then climbs back up to the level where the gap was initially observed. Although I wouldn't always suggest this method, utilizing the Extend Box feature can visually extend the gap, making it easier to track. For illustration, extending it by 30 can emphasize our anticipation of the price returning to bridge the gap we've identified in the market. Next, let's explore premium and discount zones, a concept that is straightforward yet crucial for trading. These zones help identify when an asset is in a state of being overbought or underpriced. In simpler terms, a premium zone indicates that the asset might be overvalued, meaning you're potentially buying at a higher price than usual. On the flip side, a discount zone signifies a bargain, suggesting the asset is available at a lower price. The equilibrium sits comfortably between these extremes, representing a balanced price point where the asset is considered to be fairly valued, serving as a baseline for the market within that specific range. Finally, we approach the concept of highs and lows multi-time frame, a tool that brings to light the highest and lowest price points across various time frames. For those interested in daily movements, selecting the daily view will highlight the previous day's high and low. This information is invaluable because it offers insights into potential resistance and support levels. For instance, if you spot the previous day's high, you might consider it a resistance level. This suggests a strategy where you could sell as the price approaches this high, anticipating it might not surpass yesterday's peak. Conversely, the previous day's low acts as a potential support level, hinting at an opportunity to buy, assuming the price may not drop further than it did the day before. This method of using daily highs and lows as benchmarks for resistance and support is straightforward yet effective. Some traders might even narrow down their analysis to specific days, like Mondays, to fine-tune their strategies. By enabling the Mondays feature, you'll be presented with the high and low of the previous Monday, key points that often act as the market's support and resistance levels. This information can be crucial for your trading decisions, guiding you to potentially sell at Monday's high or buy at its low. The tool is designed for simplicity and ease of use. Additionally, turning on the weekly and monthly view will reveal the previous week's high and low, further highlighting significant areas of support and resistance that could influence your trading strategies. This video aims to demonstrate how you can leverage the diverse and effective features of the Lux Algo Price Action Concepts Toolkit. With its versatility, you're encouraged to explore and identify the functions that best suit your trading style. Feel free to experiment by toggling various features on and off. Initially, activating too many options simultaneously might seem overwhelming, so it's advisable to test each feature individually. This approach allows you to customize the toolkit to your preferences, ensuring you use what works best for you.